I do like to start off the show just quickly talking with a summary of kind of what happened this week in the stock market. I'm going to do it a little bit different though, because this is the last show of the year. I really want to talk about kind of what I see happening for 2022. And this is an unbelievable time period right now, unprecedented. We have a virus, a variant right now that is doubling in number of cases every 2.5 days here in the US. We have the Federal Reserve actually starting to do things, cutting back on bonds and starting to talk about raising interest rates. We have a scenario where inflation is very high. We have high demand. We have supply chain issues. This is not anything normal about this particular time frame. Because of the pandemic, this is not a recovery out of an economic downturn. This is a reopening, which is a completely different animal. So really fascinating time frame. So here's the first piece of information that I'd like to share with you. I read an article. The author had gone back and took a look at, the S&P 500 year by year, all the way from the end of World War II to now. And what he found was that in every year where there was a 20% return or higher, which is what we should end up this year, the next year was up an average of 10.4%. So that's pretty good. Not 20, but 10.4 is right around the average for the S&P 500 long term. But more importantly, he found that the market was up in that next year 80% of the time. Okay, so that's one base case situation we have to think about here. If you think the market's going up next year, you're 8 out of 10 times you're going to be right, at least looking at history. And I feel pretty good about that, actually. At this point, when I'm looking at kind of what I weigh as the negatives and the positives, I still think the positives outweigh the negatives, and I wouldn't be surprised at all to see a positive rate of return next year. So that will happen, and we'll see what goes on. I don't react to predictions as much as reaction, kind of see what happens. But the next piece that I'd like to talk about is just kind of the way we manage money is interesting, I think, in the sense that we will take the allocation that we have for stocks in somebody's portfolio, and that can go from anywhere from 10% to 100%, and we have basically 10 models, 10% differential between each one. And we'll take a look at that and we'll say, okay, 75% of the allocation that we have in stocks, we traditionally have in these very broad indexes. So we just want to participate in the market, especially if it's going to go up, like it hopefully will next year. And so, the Vanguard Total Stock Market Index, the S&P 500, those type of things, just try to capture everything as far as that goes. And we don't have to guess there. If it's small caps that do well, we got it. If it's tech that does well, we have it. If it's value that does, we have it. Everything's in there. Matter of fact, there's thousands of stocks in those exchange traded funds, which is really nice. So then the next thing we have, though, is the rest is the 25%. We have these little targeted indexes. And that's where I'm trying to kind of find trends, where I'm going out looking for, I look at it like waves. I'm sitting there looking, for a wave to come. I want to ride that wave in for some period of time, longer the better. And so when we're looking at trends, we're thinking about the themes and what might change and why this might do well. And then I go out and see if it is moving. If it is, I often jump on that trend. But here's what I'm seeing right now. I like to kind of go through mentally and try to figure out different themes that might happen coming up here. And I can make up more themes right now than I ever could ever. Just take the Omicron variant. So for example, we could look at next year and say, hey, it turns out that it's pretty mild. Combine that with the Pfizer pill, the antiviral that currently just finished its final trial with an 89% effectiveness against keeping people out of the hospital. Let's say it is mild and it affects more people, gives them some immunity, combine that with the Pfizer pill. Wow, that's a totally different story for what could happen next year. And we might have even more demand coming out because obviously people would like to do more in that situation and travel and do all these things. And we could have a booming situation, which could cause some inflation, and then how does the Federal Reserve deal with that situation? On the other hand, you could have a scenario where this Omicron variant slows things down. So I just read an article this morning about London restaurants that are closing down for the holidays, where they make about 40% of their revenue because they're getting too many cancellations. The big Christmas parties are being canceled, and because people are afraid of the Omicron variant. And obviously right now it is spreading quickly and we're not positive what the end result's going to be. And so if you go through the year like that and you have a bunch of slowdowns, well, then you're probably not going to have much inflation in that environment. The Federal Reserve would maybe not raise rates as much and might even slow down their bond purchases, right? So that's happening. You can look at the kind of the bond market is kind of, they're looking right now, when you look at the bond market, the yield is not coming up a lot. And what that generally signals is that they're looking at an economy here in the future that isn't that hot. So again, those two scenarios are exactly the opposite of each other. There would be totally different things that you would invest in, most likely, in each one of those situations. And I can keep going, and there's just scenario after scenario. For example, there's a big assumption right now that because the demand's so high, that the Federal Reserve is behind the curve. They're going to have to, continue to raise rates and even raise them more than they're already talking about. And so, again, you would invest in one area for that particular scenario, and can make a good argument that that's a good scenario. At the same time, you could make a secondary argument that would be just the opposite, where they're not going to need to raise rates because American businesses figure out how to fix the supply chain and they figure out how to get people back to work, and then they overproduce. And this is actually a normal scenario where there's a big shortage of, let's say, cars, and all of a sudden, boom, there's too many cars. And we end up with this situation where there's sales, and that's anti-inflationary. Totally different situation than the scenario I just played out, where the inflation was still there. So again, there's so many potential issues, and it's not the normal. Normally we have this kind of relatively standard scenario of a recovery coming out of a recession, and things are happening in a certain particular way, and that's not happening at all here. And there's a lot of surprises. It certainly has caught the Federal Reserve off guard as far as that goes. So here, bottom line, in this particular type of scenario, when you have so many different cross currents coming, I really think it's still best to have a broad exposure. Okay. And so even in our case with these 4 targeted pieces that we use, 2 of them are in broad market pieces, S&P 500 and total stock market index. I have 2 more targeted pieces. I'm buying like Apple and Nvidia, companies that I really like, that have great product and good demand, good cash flow, et cetera, et cetera. And so I do think that hopefully will play out. We'll see. I'll react to it if it doesn't. And so really, the other part for our portfolio, just so you know, I mean, what I talk about within our models is generally inside of our IRAs, because we can make these changes. We have, these trust accounts and individual accounts, taxable accounts. Those are handled a little bit differently. We still have some pieces from last year, that aren't doing as well this year, but they made so much money, it's hard to take the gains and, those type of things. So I'd still be holding on to those gains as much as possible, especially since we're right here at the end of the year. But altogether, I think a broad market approach is kind of the way to go here when you get this many cross currents. This is what happened quite a few times this year, and it is really, really happening right now as we speak. We're having a lot of different issues with, yesterday the Dow's great. Today, it's not so great. The NASDAQ 2 days ago was fantastic, and then it was awful yesterday, and then small caps haven't done anything. They're doing great today. So, you're going to be chasing your tail if you're trying to find these trends, because this is just such choppy water right now. So better off just kind of participating in the whole thing and seeing how that goes as far as that goes. So anyway, that's my outlook for kind of 2022, especially for the beginning of it. I'm planning on kind of coming into that year with this broadly diversified portfolio, and that's why. And we'll see what happens. I do work on that constantly and try to see what trends might transpire. So look forward to talking to you about again this at the beginning of January, and we'll see how things have transpired between now and then.